I mentioned a couple words while I was describing these different kinds of funds that I wanted to touch on real quickly. I said liquid a couple times. What that means is the ease with which one can buy or sell shares in a particular holding. Stocks are extremely liquid. ETFs are liquid in the same way. In other words, you can go to a stock exchange, you can buy an ETF and sell an ETF. It's priced just like a stock, but when you buy it, you're buying shares of multiple stocks instead of just a single stock. But ETFs are liquid because they're easy to trade. They're also liquid in many cases because there is so much dollar value trading in them each day. If you look up an ETF on, say, Google Finance or Yahoo Finance, you can see how much volume is traded each day. And ETFs with higher volumes are even more liquid. I mentioned large cap. What cap means here is capitalization, or in other words, how much is the company worth according to number of shares that are outstanding times the price of the stock. So some really huge cap stocks, say like Apple, are worth many, many billions of dollars. So when I say large cap stocks, that's what I'm referring to. There's also small cap stocks that are similarly have lower value. And one thing to mention as long as we're on this topic is the price of a stock really only relates to what one share is selling at. It doesn't relate to the overall value of the company. We'll get into all these topics a little bit later. Now, to recap, there are at least these three types of funds. There are electronically traded funds, which you can trade like stocks on a stock market. There's mutual funds that are a little bit harder to get in and out of, but you can trade them on a daily basis. You usually have to go through a specific broker. You can't just trade them on your own. And finally, hedge funds require a specific agreement to trade into or out of. Okay, those are the three major types of funds.